Right now, US stocks are more expensive than at almost any moment in 140 years of history. By one famous measure, the market trades at around 40 times earnings, against a long-run average closer to 17. That single fact won't tell you what stocks do next year. Almost nothing can. But it quietly says a great deal about the next 10. Because the biggest clue to your long-run returns isn't the Fed or the headlines or some genius forecast. It's something far more boring. The price you paid to get in. Buy the same stream of earnings cheaply, and history tends to reward you. Buy it expensively, and history tends to make you wait. Today, you are buying expensive. This is not a crash call, and not financial advice. A high price is not a sell button. It's about setting honest expectations. Let's get into it. Start with the most expensive question in investing, when almost everyone forgets the moment markets get exciting. Every dollar you make in stocks comes from two places. 1. What the business actually earns and grows. Its dividends and profits. 2. The price other people will pay for those earnings. The multiple. Over a century, almost all of it came from the business itself. From 1900 to 2005, US stocks returned about 9.6% a year, and 9.5 of those points were dividends and earnings growth. As John Bogle put it, in the long run, it's economics that controls your returns. The emotions that feel so overwhelming in the short term simply dissolve, and the part that came from valuations rising and falling, the mood, the hype, the multiple. Over a full century, it added just 0.1% a year. Mood is loud, but in the long run, it almost cancels out. Here's the catch hidden in that. When you pay a high multiple, you aren't buying more earnings. You're borrowing return from the future. Pay up today, and tomorrow simply has less left to give. But flip the time horizon, and it completely inverts. Over a single year, mood is everything. Prices lurch on fear and greed, and valuation predicts almost nothing. Academics tested this exhaustively. Over months and quarters, valuation forecast returns no better than simply guessing the long-run average. Short-term, the price tag is basically noise. So here's the strange split at the heart of this. In the short run, valuation is useless. In the long run, it's one of the only things that actually works. The whole skill is knowing which clock you're reading. And over a decade, the horizon that actually matters for your retirement, your house, your life, the price you paid quietly starts to dominate everything else. To use that, though, you need a better price tag than the one flashing on the news. The ordinary price-to-earnings ratio everyone quotes has a fatal flaw. It uses a single year of earnings, and a single year can be a wild, misleading thing. Watch what happens in a recession. Profits collapse, so the PE suddenly spikes, making stocks look most expensive at the exact moment they are cheapest. The simple gauge betrays you when you need it most. The fix is old. Benjamin Graham, Warren Buffett's mentor, argued nearly a century ago that you should never judge a business on 1 year's earnings. A Yale economist named Robert Shiller made that idea rigorous. His measure is the CAPE. Instead of dividing price by 1 year of earnings, it divides by 10 years of earnings, averaged and adjusted for inflation. A full decade smooths out the booms and the busts. It even adjusts for inflation, so $1 of profit in 1985 is compared fairly to $1 of profit today. Apples to apples, across a full century. It's a simple idea with a deep payoff. Instead of asking what you're paying for one lucky or unlucky year, you ask what you're paying for a company's true, sustainable earning power. Strip out the recessions, the booms, the inflation, and what's left is the closest thing the market gives you to a clean read on one question. Are you paying too much? This isn't fringe theory. Shiller won the Nobel Prize in economics in 2013, in part for showing that over long horizons, prices are far more predictable than the efficient market orthodoxy believed. And once you smooth out the noise this way, something remarkable appears across more than a century of data. A relationship clean enough and stable enough to plan a decade around. Here is that pattern. And it's one of the most useful charts in all of investing. Take every 10-year stretch in history and sort it by how expensive stocks were at the start. When CAPE was at its lowest, investors earned about 10% a year, after inflation, over the next decade. When it was at its highest, barely 0.5%. And it isn't just the extremes. Run every level in between, and the pattern is almost perfectly orderly. The more you pay at the start, the less you tend to get, step by step, all the way down. Look how lopsided it is. Even the worst decade that ever started from cheap valuations still made almost 5% a year. The floor for buying cheap was higher than the average for buying expensive. And sit with this, there has never been a cheap decade that lost money. Not the Depression, not the 1970s. Cheap starting prices have simply never produced a lost decade. Now the other end. Buy at the most expensive valuations, and the best you tended to get was about 6%. And the worst was -6. A whole decade underwater, in real terms. Read that carefully. Starting expensive didn't just shrink your average reward. It shrank your best possible outcome and worsened your worst. The entry price bends the entire range of what's possible. So where does that leave us today? The CAPE has only approached today's level a few times in history. The 1929 peak before the Great Crash, the dot-com top in 2000, and the 2021 high. Today the CAPE sits around 40, more than double its long-run average of 17, and the second highest reading in 140 years. The only time it was ever higher was the dot-com bubble. To be clear about the scale, even the 1929 peak, right before the most infamous crash in history, was only about 33. Today sits meaningfully above even that. So the math here is blunt, not dramatic. Buying at today's prices, history suggests you should expect below average returns over the next decade. Not a crash, just less. And remember what this is: a base rate, a powerful tendency, not a promise. Any single decade can break the pattern, but betting against a century-long relationship is its own kind of gamble. Now, the most important warning in this entire video, because this is exactly where people misuse it. A high CAPE is not a sell signal. Let me say it plainly. It has almost no power to tell you when. Expensive markets can stay expensive and get far more expensive for years. Here's the proof. The CAPE blew past 30 back in 1998, screaming expensive. If you'd sold then, you'd have missed the S&P roughly doubling, up about 150% before it ever peaked. It didn't actually peak until December 1999 at an all-time high of 44, the most expensive the US market has ever been. Overvalued got more overvalued for years on end. And yes, the reckoning eventually came. The market fell about 49% from the 2000 peak. But the CAPE had flagged that risk years early. It told you danger was building. It never told you when. That's the core lesson. Valuation is a measure of risk and expected return, not a clock. As one researcher put it perfectly, a warning sign is not an action plan. And to be fair to the bulls, the critics make real points. Today's CAPE may be running a little hotter than old eras for a few honest structural reasons. Companies now return cash through buybacks instead of dividends, which flatters earnings growth. Accounting rules changed, depressing reported profits. Both can push the modern CAPE somewhat higher than in past decades. One concrete example, the share of profits paid out as dividends fell from about half to roughly a third as buybacks took over, which quietly flatters the earnings side of the formula. And lower interest rates, some argue, justify paying more for stocks. Maybe. But Shiller had a warning. Nearly every era invents a clever reason why, this time, high prices are permanent. They almost never are. So hold both truths at once. Today's gauge may be running slightly hot, and even fully adjusted for every fair criticism, it still sits near the very top of its entire history. So if it's not a sell button, what is valuation actually for? Think of it as a thermostat, not a trigger. It doesn't tell you to act. It tells you what to expect, and lets you prepare instead of predict. Over a century, the link between your starting valuation and the next decade's returns is strongly negative. A correlation around minus 0.7. Strong enough to respect deeply, far too loose to time. And even that explains only about a quarter of what actually happens next. Valuation sets the odds. It does not script the outcome. There's enormous room for surprise inside that range. Vanguard states it cleanly. As valuations rise, both the odds and the likely size of a future decline tend to rise with them. A strong relationship, just never a precise one. So the smartest use of it is humble. As one famous investor put it, the Shiller PE has very limited use for timing the market. But you're making a mistake if you don't lower your expectations when it's high. The same investor mapped the whole curve. As starting valuations climb, the average return falls, the best case weakens, and the worst case gets worse, all at once. Practically that means don't flee and don't pretend. Keep investing, stay diversified, but plan around leaner returns, maybe save a little more, and don't assume the last decade simply repeats. And it cuts the other way too. When valuations are low and everyone is terrified, 1932, 1982, 2009, that's mathematically when the next decade has tended to pay the most. The best prices come wrapped in the worst headlines. The decade after the year 2000 proved it brutally, roughly 10 years of near zero real return, exactly as those record high valuations had quietly warned in advance. Because here's the part you actually control. You can't control the market, the Fed, or the next 10 years, but you can control the price you pay and the expectations you set around it. None of this is financial advice, and it's a way to read the market honestly. Mind the price, set your expectations to match, and let time do the heavy lifting. If this gave you a clearer view, follow Market Minute. I'll see you next time.